Property, for a lot of people, it's more than just a place to live. It's like the bedrock of their wealth, a really core part of their investment strategy. So in this explainer, we're going to break down why property is seen as such a huge deal and how you can get in on the action. Let's dive in. So let me ask you this. Are you looking for an investment that delivers real, long-term returns and can actually stand up to inflation? Well, that's why we're talking about property. It's often seen as the go-to for exactly that. But what is it really about good old bricks and mortar that gives it this reputation for being so resilient? Let's unpack the core benefits. Okay, so when you boil it all down, property brings a few really key things to the table. First, it can deliver those real long-term returns, but often with less of the wild day-to-day swings you see in the stock market. You also get a potential stream of income from rent, which is huge. And here's the kicker. Its value doesn't always move in lockstep with stocks and bonds. That makes it an absolutely powerful tool for diversifying your portfolio. But, getting into property isn't some one-size-fits-all deal. It's not that simple. Every single investor, whether we're talking about a massive institution or someone just like you, faces this one fundamental choice right at the very beginning. And trust me, this choice basically defines your entire experience with property as an asset. And that brings us to this big fork in the road. Think about it like this. On one path, you've got direct investment. That's the hands-on approach. You're buying and managing the physical properties yourself. Then, on the other path, you've got indirect investment. That's where you buy shares in companies or funds that do all the heavy lifting for you. See? Two totally different paths to the exact same goal. All right, so let's start by heading down that first path, the hands-on route, direct investment. This is probably what most of us picture when we hear property investing, right? Actually owning the bricks and mortar yourself. But whoa, the reality here is way more complex than it looks on the surface. I mean, unlike a share of, say, Apple stock, every single property is unique. Its value, totally subjective. It's not like it's updated every second on a stock exchange, and that makes it highly illiquid. You can't just click a button and sell it instantly. Then you throw in the high costs, the complex legal stuff, and the fact that it's really, really hard to buy enough properties to be properly diversified. And you can see how the challenges start to stack up fast. And even within this hands-on world, there's another split you need to know about, residential versus commercial. With residential, you're usually looking at shorter leases, you as the landlord are handling the repairs, and your returns are often tied to the house price going up. Now, commercial properties, we're talking offices, warehouses, that kind of thing, that's a whole different ballgame. You're looking at really long leases, the tenant usually covers repairs, and the main focus is on that steady, reliable rental income. So here's the big takeaway from all this. Because of the crazy high costs, the complexity, and just the sheer amount of money you need to build a properly diversified portfolio, direct property ownership is, well, it's often a game best played by huge investment funds or the super wealthy. For most regular people, it's a really tough path to go down. Okay, so if that first path sounds a little daunting, what about the other one? This brings us into the world of indirect investing, a route that honestly opens up the property market to a much, much wider audience. So one of the main ways to do this is with something called a property fund. And it's a simple but really powerful idea. Your money gets pooled together with thousands of other people's money. Then a professional manager takes that giant pool of cash and uses it to buy and manage a whole portfolio of different buildings. You basically own a tiny little slice of a very big pie. And a hugely popular way to do this is through a REIT. That stands for Real Estate Investment Trust. Just think of it as a special kind of company whose entire job, its one and only job, is to own and operate properties that generate income. Anything from shopping malls to apartment buildings. And here is the absolute game changer with REITs. They are traded on stock exchanges, just like any public company you can think of. It's a brilliant setup, really. It takes this massive, illiquid portfolio of real estate and turns it into a liquid investment that pretty much anyone can buy or sell with just a few clicks. And here's kind of their secret sauce. Check this out. To get special tax treatment, we're talking avoiding corporate income tax, REITs are usually required to pay out at least 90% of their taxable income to their shareholders as dividends. And what does that mean for you? It makes them especially attractive for investors who are looking for a steady stream of income. So let's just recap the big advantages of going down this indirect path. First, you get liquidity. You can buy and sell your investment super easily. Second, you get instant diversification across tons of properties and locations. Third, the cost to get started is low. You can just buy a single share if you want. And finally, you don't have to worry about leaky faucets or chasing down tenants for rent. You've got professionals handling all of that.
Okay, but let's be real. No investment is a sure thing, right? To make a smart decision, you absolutely have to understand the potential downsides. And that's true whether you're investing directly or indirectly. All right, first up, let's talk about the risks tied directly to the physical properties. You've heard it a million times. Location, location, location. A building's value is all about where it is. Then there are the tenants. Their financial health is critical. I mean, if they can't pay the rent, your income just stops. And of course, the length of the lease determines how stable your future income is going to be. These are the real on-the-ground risks. Then you have to zoom out and look at the bigger market risks. For example, rising interest rates can make borrowing more expensive, and that can push property values down. You also have to think about different sectors. What's happening with office buildings might be the total opposite of what's going on with industrial warehouses. And of course, in a recession, that rental growth you were counting on can slow down or even go backwards.
And finally, there are risks that are specific to the investment products themselves. Some funds, for instance, face what's called a liquidity mismatch. Here's what that means. In a crisis, if everyone panics and rushes to sell, the fund literally can't sell its physical buildings fast enough to pay them all back. And what happens? It's forced to freeze withdrawals. We actually saw this happen back in 2008 and then again in 2020. The other big one is gearing, which is just a fancy word for leverage or borrowing money. Sure, it can pump up your gains when things go well, but it will absolutely magnify your losses when they don't. And that brings us right back to where we started, to that central choice. So when it comes to building the foundation of your portfolio, what really makes more sense for you? Is it the direct control and all the responsibility that comes with owning a physical building? Or is it the liquidity and the built-in diversification of owning a small share of many? The answer to that question really defines your journey as a property investor.